Welcome to the GRID Charleston Podcast. This episode is a live recording from our most recent GRID event. You can check out upcoming events at gridcharleston.com. GRID happens every third Tuesday of the month at 5:30 p.m. right here at 1349 Old Georgetown Road in Mount Pleasant, South Carolina. Special thanks to our sponsors who make these events free for the community: Coastal Equity Group, Sweetgrass Capital, Matt O'Neill Real Estate, Tide Property Management Co., Refresh Your Nest LLC, Coastal Creative LLC, and Mitchum Law Firm. In this session, we sat down with Chris Yeagle, managing partner at Eastgate Multifamily, one of the Southeast's top apartment brokerage teams. Chris and I unpacked what it takes to invest in apartments and scale your portfolio, including how market cycles shape strategy, why discipline has returned to multifamily, the difference between asset management and property management, and the habits that separate small operators from large-scale owners. It's a master class in treating real estate like a real business. Let's dive in. Tonight we are talking about how to invest in apartments and how to scale your portfolio. So there's not very many people, well, there's a good amount of people who have done this, but I was trying to find someone who had done this a lot of times with a lot of different people, clients, and I couldn't think of anyone better than Chris Yeagle. Chris is the managing partner at Eastgate Multifamily, a boutique commercial real estate brokerage that sells apartment communities and multifamily land throughout the southeastern United States. With 26 years of multifamily brokerage experience, Chris provides an unparalleled service and results to both his clients and his customers. Guys, please help me in welcoming Chris Yeagle up to the front of the room. All right.
That was a great way of saying I'm old.
Chris, so tonight, what we want to talk about is patterns that you've seen. You've worked with a lot of clients, I'm sure, over your 26 years, right? People who have been really successful, people who haven't been super successful. What we want to learn tonight is, number one, how one would invest in apartments and do that really, really well. And then number two, the patterns that you've seen people who are able to, go from a small number or smaller properties to large properties, right, over their tenure. So, but before we do that, Chris, I just want to give the room a little bit of background. Do you mind just telling everyone about yourself, who you are, how you got into this, and why you're still here?
Yeah, so right out of college, wanted to be in real estate, be like a family friend. I didn't ask for help and just stumbled into brokerage. Worked for, a regional firm, ultimately started my own firm here in Charleston, sold that. Eastgate is just a reincarnation of what I used to do. But, I've had the fortune of working with a lot of really great guys, both on the brokerage side, but also clients. Been through a lot of, I guess we would describe cycles. I started out in Florida, and Atlanta. Right when the tech bust happened in '99, and then the insurance crisis in Florida of 04 and 05 and 06, and then the crash thereafter, and you name it, it seems like every couple of years something throws a wrench into things, and you'll just learn a lot of hard lessons. Hopefully we can help our clients avoid those issues moving forward. But yeah, it's just kind of the only thing I've ever known. Probably self-employed, not by choice.
You've been through a lot of market cycles, and brokerage is a career where your compensation is very much tied to the transaction volume that's happening, right? How do you get through it? How are you advising clients through down cycles, through up cycles?
I think the challenge today is, it's hard to get people to accept this, but in my opinion is, the last 10 years were not normal. And so, the last 10 years, if you just thought of it in terms of homes, it was pretty hard to screw up. And it was very much the same way with commercial. And so, it allowed people to kind of not be disciplined. And so much like in my 20s, I could eat whatever I wanted and still be in shape. And now in my 40s, I'm not allowed to eat anything. It's sort of that difference there, I think. And so people, the last couple of years, people have started to realize I need to be more disciplined. Maybe I have some legacy issues, some problems I'm dealing with. Maybe we're changing our strategy, particularly for apartments and commercial assets. The larger assets, the flip and fix type stuff is much harder to do now. And so we're seeing our clients kind of transition a little bit more towards a more traditional holding period, which in apartments might be 5 or 7 or 10 years. But, over the last decade was 6 to 24 months. And so, I think that's probably the biggest change that I feel like I'm seeing is just things have changed enough to get us a little bit back towards, a more disciplined market.
Would you say a normal market?
Yeah, I would say more normal market, which is defined by discipline, in terms of, and probably allows buyers to be more opportunistic, right? 5 years ago, we'd have 20 people beating each other up for a deal, and now it's kind of back to normal. I tell clients, you might have on a deal 20 million or less, you might have 2 people at any one point in time. And so, you can still only sell it to one person, so that's pretty good. It's definitely changed, and I think buyers can be more disciplined, stick to their guns, their investment decisions. Sellers are really struggling to comprehend that the market has changed. I don't want to say no longer get to call the shots. It's just doing the deals a little bit more of a marriage. It's a partnership to get to the goal.
Describe, because the majority of the people in the room haven't been in a normal market. Describe what a normal market is like.
The market was so weird, I think really around 2018, late 17 and 18 and going into 19 that, I would call up friends of mine and just be like, what the hell's going on? Like, how did this deal make sense? How did that deal make sense? And, where you, as a broker, you almost couldn't dream. It was like a dare to dream situation of how much a property could be worth. And so, that was, I think, particularly frustrating, where you just really couldn't, for things that should be math, you just really couldn't sit down and tell a client with math, this is what it is. It's like, well, this is what it should be, but who knows? And now it's much more back to basics. Like, all right, we've got a business plan and the banks are looking at us and, everyone's sort of double, triple checking things. And there's not this, the last 10 years, it was like every time you turned around, someone was bailing you out. And now, but a lot of that is just your game plan of, am I going on a date or am I getting married? Right? And so, if I'm just buying this property to flip, throw a little bit of lipstick, I don't care about fixing the important stuff. Whereas if you say, hey, I'm going to own this and be in it for a little bit longer period of time, maybe I need to slow down to make sure that I'm doing things right. And, because it's going to be my problem to deal with in 2 years, 3 years. I do think a normal market, though, is defined by like, time heals all wounds and heals it very well. And I've got, a lot of great clients out of New York, and their favorite saying is like, if I'm going to make a mistake, Charleston's a great place to make it. This market we're in particular is very resilient. Even throughout the crash, so.
What makes the Charleston market resilient compared to other markets?
In the crash, every deal I ever sold in Florida, except for one, went into foreclosure, which was debt. It was driven by debt. You could buy a deal and get 110, 120% LTV. And, if you watch like The Big Short or any of those movies, all the shenanigans that you saw on the lending side existed, definitely. I think, part of in the crash, what made Charleston resilient, what helped was, for whatever reason, they didn't write the same kind of loans here. More people had longer term loans rather than shorter term loans, and that just largely saved them. I do think the general economy obviously grew, it exploded. We've been very fortunate to have great employers come in, but so is the rest of the Southeast. It was really about the loans, and that's where, when I look at deals, if we talk about getting back to normal, it's just having a longer hold period, making sure I'm getting a loan that's going to be with me through that period and not just, grabbing a loan that works for 12 or 16 months, and if everything goes perfect, wonderful, but what if it doesn't? And it's real estate, it never does. So, it's kind of just, I think that's the weird thing about the last 10 years was no one was ever trying to look ahead and see where the problems might be.
Yeah. I feel like recently, I was talking to someone before the meeting started about this, but I feel like recently I've been having a lot of conversations with people who were buying in like 2020 and 2021 with a 5-year hold plan, or maybe 2022 with a shorter term hold plan, right? But we've been having a lot of conversations with people, hey, you were pricing in rates being at X amount, rates are not at X amount anymore. Have you also been seeing that on your side?
Yeah, the reality is like if you bought, particularly with bridge debt, or any kind of short-term debt in 2020 through 2022. Depending on the market you're in, and I sell apartments really from in Florida, Georgia, and the Carolinas, so I see stuff throughout the Southeast. You could have executed your business plan flawlessly, and depending on the market, might still be at break even or at a loss. And so, we're seeing some cash in refis. We're seeing some guys give deals back to the bank. But ultimately, I think a lot of that just comes down to there's always variables in real estate and just how effectively are you managing it. And that's where I think people maybe didn't learn or lost sort of the muscle memory over the last 10 years of you actually had to manage your properties, asset manage them, pay attention to them, execute to get to your goal. And that the last 10 years really just sort of allowed people you could fail upwards.
So tell us, when you're looking at opportunities, maybe it's like back of the napkin math or something, you look at really quick, a snapshot of a property. What do you look at and think, maybe there's a deal here?
For me, it's usually price per unit, price per pound. Does this just feel like a good price? It's really hard to go wrong with a low basis. I know different people have different metrics. Someone told me one the other day that seemed right. It was he multiplied whatever the monthly rent was by 100, and that should be roughly the price per unit. And I was never thought of that. That kind of works. I'm usually just simple math. What is the rent? Multiply it by 12, 10% vacancy, 50% expenses. That gives me a number, and then what do I think is a reasonable cap rate? But my detailed underwriting, nothing's really changed in my career. We're always solving for cash on cash returns. The idea being that if I go to a wealthy individual to borrow cash, they'll accept excuses in year one, and maybe if it's a construction deal in year two, but somewhere by year 2 or 3, they want a return that should be reasonable, relative to their opportunity costs.
So cash on cash is the gold standard that you've seen?
It's pretty hard to manipulate cash on cash, whereas IRRs and cap rates and all this other stuff is very subjective on what happens in the future. But if you're really just looking at an asset saying, what kind of cash on cash will we be delivering in year 2 or 3? That tells you I've got a pretty disciplined business plan as to how to get there. And it will vary because it's real estate.
Yeah.
It's and nothing will go right in year 1.
Yeah.
But we try not to. You try not to financially engineer a deal.
Yeah. What do you mean by that?
Just, does some kind of creative debt solution solve the problem, or do you raise more capital going in than you need so you can pay the investors the cash on cash that they want year 1, which is paying them with their own money? I don't know why people don't do more math on that.
So you're saying for the people who are operators in the room, the best way to underwrite the deal isn't to go and do whatever the gurus are saying. It's to just do the traditional route, just assuming the traditional style debt. And
yeah, just, I think the gurus are, you can almost just draw a family tree from where they all started and who took what class and how they've all grown. And they've really turned it into a business itself. And for what it's worth, some of the best of them are making low 7 figures a year selling courses. So I think a lot of them do give some good advice. And we've had some clients that have done very well with them. And, in terms of coming up with a template of how to do things that maybe you didn't know how to do. But I think the ones that have done best have really kind of applied common sense and good, good morals and ethics and everything else.
So when you look at let's say newer clients or newer investors jumping into apartments, what is the most common way you've seen people shoot themselves in the foot?
I think just not understanding that there's a role in real estate that's asset management. Most people think I just buy the deal and then the property manager handles everything else, renovations, that kind of thing. And asset management it's a job unto itself. And so until you're big enough that you can hire someone, a gray star asset manager probably makes $150,000, $200,000 a year. It's a real job. And that guy only oversees so many assets. And so until then, it's your job. And I think a lot of people didn't really realize that role existed. And if you went to a guru course, it certainly wasn't talked about. But it's the basic stuff that you would probably do if it was just your own money in a deal. I'm going to drive by that property and check up on it.
Yeah, that's what I was going to ask, is describe the job of the asset manager.
It's basically the person that oversees how do we get stuff done. They're the one that's saying, here's the business's plan. How do we implement this? Whether we are the ones that are overseeing the contractors or, the construction crew or just making sure that the property management's doing what they say they're going to do. I mean, a lot of people just think the property management will handle everything, and a lot of them do sell themselves as handling everything and have, and some do very well. Some have just their own profit centers out of that. But I think of it as like the quarterback. Like once you own the deal, there's this guy that's in charge of getting the deal done and seeing things executed. And so that's really it. Ideally, the person that bought the deal, the main guy, is when they do separate, he's kind of in charge of raising equity and buying more deals. But he can't keep that wheel flying without having someone to do the other job.
Now, describe, because I know that we have quite a few new people in the room, the difference between like what an asset manager would do versus what a property manager would do.
I mean, my opinion is the property manager's there to just simply maintain the asset and lease it out. That's largely it. That's what you're paying them to do. That's all their job should be. I think in the apartment world, expectations have come to grow that you can renovate my property and do this and do that. And I mean, for a price, I suppose they can, but
yeah.
They're there to kind of give you good advice and do their job, but their job might be limited to certain aspects. And the asset manager's role might really be like, hey, I need to make sure this project is getting done, and maybe it's getting done by a third party. And if it's not, then am I compensating my property manager essentially enough to do that asset management role? And the answer there is always no. Property management does not get paid enough.
If a deal goes sideways, like after closing, what's usually the reason that you're seeing? It's
asset management.
Is it really?
You didn't show up to the property, you don't know what's going on. I can't tell you how many times I'm selling a deal and someone's like, oh, I must have this, or this can't be wrong, or this can't whatever, and they haven't shown up to the property in 3-4 years. So it's asset management. That's it. Don't buy something that you're not going to show up to, or send someone to go see. Unless it's like a Chick-fil-A or something. Triple net deal. So it's that. It's exclusively that. Like 99% of the time. So I wish there was more to elaborate on that.
No, I think it's great. It's simple and it's true. What's one piece of advice you'd give to someone looking to enter the apartment space as an operator?
I think just, take a measured approach. So like if you're working a regular job, I would probably challenge you that buying more than 2 apartment communities a year is probably going to stress your ability to either maintain your current job or turn the properties like you wanted to, assuming you're adding value to them. So I find my clients in their early years, like there are quite a few that they've just got a routine. They're like, let's buy 1 or 2 deals a year. It's pretty hard to screw that up. You kind of keep things going. And then once you have a deal that's stabilized and it's been stabilized for a year, you pretty much know exactly how it's going to run. You can spot a variance really quick. And so it's kind of hard to screw up that tempo. And that's a really, if you want to do more deals, that's great. You can create more opportunities, but maybe that also means that maybe you can be more opportunistic. And instead of trying to jam 4 deals into a year, maybe you pick 2 really good ones. I would definitely do that for the first few years.
Yeah. And then on the flip side, someone who currently is owning and operating apartment communities, what advice would you give them for present day? Maybe it's like a hack, something that provides a ton of value that doesn't cost a lot of money, or market-driven advice. What advice would you give?
I always love the guys that have owned them long enough. Without like saying some names, but you know who we've sold for. Like, I see some of those guys and I'm like, I just want to be like him or her. They've owned it long enough. They don't even care how it runs. Like it's under market rents and they're totally happy. But I think for the guy that is in the real world, that has not already owned something for 15 years, I would walk your property once a quarter yourself, unannounced. I mean, properties always look better when you tell your manager you're coming. So show up on a day when they aren't expecting you. When we go to sell, I'll walk the perimeter of every building. I'll create a short list for a client. Here's some things to do, usually less than $5,000 or $10,000, which on a $10 million building is not a lot of money. I've never had a client do it once, not once. And it's like, just make sure your gutter kickouts are there, splash guards are there. If the weeds are growing up the HVACs, like pull them out. If we make an air conditioning unit look like it's perfectly maintained, no one's going to question it. If it looks like it's garbage, they're going to just replace it, all of which comes out of your thing. But most of them won't do it. The property is either in perfect condition when you list it, or you tell them the simple things to fix and they just won't do it. They can't be bothered. Ultimately, I guess I'm always a little surprised at how little the client cares about the result after they list the property. They damn well do when they're negotiating, right, with the broker. What's the price going to be? But then when you give them a goal of like, let's spend $5,000 cleaning things up and maybe we'll make another $500,000, and they just can't be bothered. And I think that's a bit of an asset management issue as well. Like, well, do we have the bandwidth? I got to do it. I don't have someone to do it. So
I know you've worked with a few clients over your career, I'm sure, correct me if I'm wrong, that you've seen go from a small number of units to a larger number of units. What do you see with those clients? What are they doing differently from someone, say, who is stagnant or fizzles out of the business?
Well, so I think there's two talking points on that. So the first I'm a little critical of, like in the past years, the last 10 years, when you saw people ramp up big, and some of them near $1 billion. A lot of the guru courses were really coaching on how to earn fees off of acquisitions. And so lots of times we would see very heavy fees on an acquisition with an investment thesis that doesn't make any sense because the doctor investing in it wouldn't know better. And that's the reality of it, is like, a lot of the guys that were doing business the last several years were in it for the acquisition fees, and I had retail level investors that probably did not understand what they were investing in, but it was very clearly disclosed in the documents they didn't read. And so, examples would be $3 million acquisition fees on deals that should have been $1 million. And these are big deals, obviously, but we're talking multiples of what fee level should have been. So some of those people the people you saw really ramp up, that's why they ramped up. Very cheap debt, they could kind of flip deals. They're selling a dream to earn their fees up front. And I don't know, a lot of them would give me very good critique as to why a deal was not worth something. And yet you see them turn around and sell the other side of it when they're getting a good fee. And so the ones, though, that, let's say, like do well, that we'd love to model ourselves off of, I think really put the systems in place. And so, we have a client that has scaled up very fast to where I'm a little concerned. But to their credit, like, I think with every dollar they make, they're hiring another professional to fill in the gaps. And so I think if you just said, I want to buy 10 deals a year, 10 large apartment communities a year, like as long as you're staffing up, and we all live in Charleston, so I would just be stealing people out of Graystar, but that's expensive. You're really investing in your human capital there.
Yeah.
Otherwise, it's more progressive. It's like, hey, maybe first couple of years we're buying a deal or two, and then maybe we've got enough staff where we can do 3 and 4. But I think if you're making sure that you're buying it for the deal and the investment return and not the upfront fee.
You have like the people recently who have been taking a large fee up front, right, in the guru courses or whatever, but in a normal, the way the structure that you were discussing, the way that it's been previously, other than the last 5 or 10 years, how have you seen those deals set up?
Well, the fees still always existed. It's just more of like there was more of a long-term outlet, and I think like a discipline in terms of return. Whereas what I would argue right now is there were a lot of deals done where the people clearly knew it was not going to work out. So, I tell my wife, like, if I die and the insurance money's there and she needs to invest, like, just invest with someone that was doing this before the crash, because then you'll know how they kind of handled a shakeup. And in theory, that's what we're going to be seeing now, the last couple of years, and the next, several years as well. How did you handle those deals that maybe you bought in 2020, 2021 that ran into some problems? How did you treat your investors? And we do know a lot of investors that even when their deals fell short, actually made their limited partners whole. So you do see a lot of good despite some of the bad.
Yeah. For someone who is an operator wanting to find deals, you keep saying, hey, find the good deals, find the ones that make sense. How do you find the good deals? Where are you looking?
Yeah, so I think it's important to disclose, like from our side of the business, I think ultimately the market will speak to a price no matter how much we want to price it. There's very few times where you can make a market, at least for commercial. And so, I'm never offended by someone's opinion of value, usually because every time I've told someone they're wrong, I was proven wrong. But I think if you're looking for the deals like that meet your criteria, a couple things help. The first is when you get your first deal, after that's just like the friction's broken, and it makes it so much easier after you've got one deal to get more deals. It's very hard to be a first-time buyer with a lot of brokers in general, but particularly apartment brokers. They just don't think you're qualified. Some of my best clients were actually first-time apartment buyers where, now they own $1 billion of real estate or more. But it takes a long career to kind of see that those people kind of grow, and I don't think a lot of people have been in the business very long on the brokerage side either. So to be fair, a lot of your brokers are actually suffering as much as the owners because they're having to learn to sell when in the last 10 years they didn't have to. But I have different strategies. Like I think if you're looking to do something in the Charleston metro or the metros, you're really just trying to stay on top of every deal. The more you can kind of define territory, the better, because if you tell me, I love North Charleston, but I hate Somerville, like that's a pretty declarative statement. And as long as you keep sticking with that statement, I will know this guy only likes North Charleston, and what a pitch to tell my seller. And on a bigger scale, we use this with guys, for like Charlotte, like, hey, rather than look all over the Carolinas, what if you just focused on Charlotte for 1 year? And instead of talking to 30 brokers, you only had to talk to 10. And you were just very disciplined about, this is what I want. And you could apply the exact same thing in a much smaller metro where it's like, hey, I'm really looking for 4 to 20 unit deals, that meet these specific criteria. But Charleston is a small market, so from the multifamily perspective, it's a little limited there. So you probably have to be more patient, which probably falls well into a disciplined, investment plan. So I personally have a dream of I'd love nothing more than to own within a mile or 2 radius in the Upper Peninsula in North Charleston, a whole bunch of small apartment communities, and then just have one big leasing office in the middle that's amenitized. And, take a bunch of 4 and 10 unit buildings and essentially have a 400 unit.
Did you guys write down that strategy? That's the winning strategy.
Take it, because I'm not going to do it. But, there's a lot of different ways, but I think it's just staying disciplined, looking at a lot of stuff, following up. Deals fall out of contract all the time. We don't talk about it, but it does. So, and you sort of know a certain, like on my deals, we know a certain cadence as to where deals go, the timing of when they go bad, where the pressure points are. On smaller deals, I don't know what it is, but, our deals, when a deal's awarded, you kind of know 2 weeks later a contract should be signed. So that's a pressure point. Follow up with the owner or with the broker. Is it Paul? Is that contract going well? Do you need to replace them? And there's 30 days worth of inspection. So you follow up again in 30 days. You're like, hey, how's that maybe in 3 weeks? How's that inspection going? Is he going to have problems? Is he retrading the price? So there's these sort of moments where maybe you could step back in. And I think just being consistent with the brokers, giving them good feedback, touching base. I think I emailed you a spreadsheet, but we even put together a spreadsheet for a client that was like, I don't have time to prospect. And you could pick 20, I think it was 20 brokers. You got 4 weeks in a month, 5 days in a week. You can basically cold call 20 brokers once a month and email them once a month and do it on alternating days. And if you can't make a phone call and an email a day, you probably shouldn't be in the business.
I'll share the sheet with everyone after the meeting today. But it's a really great sheet.
Yeah.
It just breaks it down. It's very simple on what you need to do every day to just stay top of mind with the people who are doing the most deals in the market, which are the brokers, right?
Yeah, because I can't tell you how many times a guy calls me and it's just like, hey, I'm looking for this, and I'm driving right by it. And I'm like, yeah, let's call that guy, and you do a deal. So some of it's that. It works well for brokers as well, for us, at a bigger scale.
That's right. Chris, this has been awesome. Can everybody give Chris a round of applause? All right, so we ran a little bit over, but let's take 15 minutes. We'll break out into our tables. If everybody can introduce yourself to everyone else at the table, talk about what you do, why you're here at GRID, and then just talk about a challenge that maybe you're having with scaling or investing or getting into the business, or if you're a current operator, just a challenge that you're having. My hope is that for the next 15 minutes or so, you guys can learn about each other, network with each other. Let's try and come up with 1 or 2 questions as a table and bring it back up front to Chris towards the end. We'll take about 15 minutes questions, have a live discussion, work through those questions or scenarios or whatever's going on, and then we'll break for the next event. So there's food out in the hallway, there's drinks, please go grab some, and then let's come back to the tables. Thank you guys so much. We'll be back in 15 minutes. Okay, let's start with the back left table. Let's see any questions that you guys have, takeaways that you want to bring up.
Is there a sweet spot relative to 10 units, 50 units, 100 plus units? Is there a sweet spot in the multifamily right now that I should focus on?
Yeah, so I always look at like the opportunities that I see are where deals are hard for me to sell. And so if we look back to the insurance crisis, what they'll call it a crisis in Florida the last couple of years, and a lot of clients were running from Florida, and I really felt like that's the time to run in because the high insurance cost is baked in. It's probably not going to go up that more. No one wants to compete for it. And the odds are really good that it's going to go back down, and that's going to allow us to, in a syndication deal, that's going to allow us to kind of outsize our promote. But right now, it is very difficult to sell a deal $20 million. $20 million or more, we'll still move it all day long. There's plenty of institutional capital, really chasing $40 and $50 million deals. 20 million or less covers quite a bit. That's basically 100 units or less, maybe 150 or less. And so they just want larger deals. It's sort of weird, but it's easier to raise 5 million than it is 1. And so, you could have a fantastic deal, but if it's just not big enough, they don't have any interest. And so for a buyer, well, as a broker, part of the reason it's more difficult right now to sell those deals is a lot of the people that were buying them have sort of legacy issues. Maybe their deals aren't going as well. Maybe they've tapped out their pool of equity. Maybe that equity is frustrated. They haven't, distributions have stopped or they haven't gotten returns. And so we're being very nice to people. Deals are 20 units or less. We need buyers. I mean, that's just the reality. And I don't care what a broker tells you. It's a lie. We're always lying, but those are very difficult deals to sell.
Percent vacancy. I think you mentioned about 50% maintenance.
Expenses.
There you go. Would you mind expanding, what you mean by the different percentages and kind of what to expect in that?
Yeah, so that's true back of the napkin math. Like that's just, if I'm eyeballing a deal, it's not so much that a property is actually physically 10% vacant, although it very well could be in some markets. It's more of like, okay, if we think of a stabilized vacancy as 7%, and then there's, 1% concessions and 2% loss to lease, or more likely it's probably 1% concessions, 2% loss to lease, 2% bad debt. So it's probably closer to 11 or 12%. But I'm a broker, I need to keep it simple. And then the 50% expense ratio, that is truly just like I take a stab at an expense ratio, but it's pretty close. Some markets, it might be a little higher, some it might be a little lower. As your rents get lower, the expense ratio goes up quite a bit. So, but it's good back of the napkin math. Yes, so we're seeing default rates go up, a decent bit, nothing too scary. For me, the more eye-opening thing is the rate at which people are no longer willing to capitalize or recapitalize a property. So let's say if you had to do a cash-in refinance, we're seeing some groups, even if it was a modest amount, just I don't want to put any more in. I'm done. We're seeing other larger syndications where, to recapitalize the deal, but they might dilute the existing equity partners. And then there's an awful lot of them where it's just the deal's gone. It's going back to the bank. And I think those are kind of the interesting opportunity because the way a lot of these syndication deals were structured through gurus was you made your fees up front, and if the deal went according to plan, you made a bunch of money on the backside. What does that guy do when he realizes he's not going to make his money on the backside and might have to refinance and manage an undercapitalized asset for another 5 years? He more often than not just quits. It's almost easier to find new equity partners than it is to work hard on a deal. That's not everyone, but we're seeing a number of people do that.
Thinking back to the time when you first started your first brokerage, for anybody who's thinking about doing something like that, were there any mistakes or lessons learned starting that brokerage?
Oh, there were so many mistakes. I mean, it was 2009, so I'd done it for 10 years. And so I will say, I had the fortune of working with friends at another brokerage that they were bankrolling. So I can say that collectively, we learned a lot of mistakes off of, my generous friends' own investment. And we're still friends today. So despite being competitors at one point even. So it was a little bit easier. I say this on camera, but I think I cared too much and tried too hard for the clients. And I think an outside opinion that might have looked at the brokerage would have said, what's the business model? Right? So like if we think of it in terms of a resident, do you have a resident that fell in bad times and maybe you're cutting them some breaks or everything else? Or is it just you're late, you're out? And so probably if I was starting a brokerage again, I think I would have done two things, which we talked in the hallway. One, I didn't figure out till 17 years in. I would not be in Charleston. It's too small for what I do. There's not enough apartments. And I think I would treat it more like a business. I mean, I'm changing a little bit now as it is with our business. I mean,
I'm getting like a very similar theme with you this evening, Chris. It's treat the real estate like a business, treat the brokerage like a business.
Like a business.
Right? It is a business. That's right. Everyone thinks real estate is different. It's not different. There's income, there's expenses. You have to manage both. And it has to make financial sense, right? Otherwise, it doesn't work and it ends badly, right?
I think the one thing that I will say that I probably didn't figure out until about 4 years ago is it's completely acceptable for my business model to not match up to a client's business model. Perfectly fine for both of us, for me to have the way I do a business, for him to make the choice that he wants to make in terms of who he selects. Even though I sell apartments and he owns apartments and buys apartments, they do not have to match up. And I think when you kind of start to think of things that way, it makes it a lot easier.
Is there a specific thing, like besides just personality, that makes it?
No, it might just be like, hey, maybe this is the fee I want. And maybe they're not prepared to pay that fee. And that's like, well, that's okay. I can only sell so many deals. And so this is the fee that works for my business. And there's another property around the corner. But that is the reality of like, there's a limited amount of what I can do. So that's a fair example. I could come up with 100 of them. But, where you really kind of figure out who am I, what am I doing, how am I doing it, and sticking to it.
It's a great question. Good question, Paul.
So with the market changing, as we all know, and things are adjusting, and as things are coming down now, do you see more foreclosures starting to happen with people that overextended themselves and things going back to the bank? And if so, what do the banks do in order to get rid of the asset? Because we know they're not in the real estate business. Do they give them back to you again to sell, or how does that work?
It depends. So we have been seeing losses on loans. So maybe not foreclosures, but let's say like short sales for at least 3 years. So this is nothing new. We've seen in the multifamily world some pretty spectacular failures that are really well profiled in certain publications where guys just lost entire portfolios. We're talking thousands of units. Those transitioned pretty quickly. Most of them were through debt funds, which are not necessarily traditional lenders. It's just basically corporations lending out money, and so they've got a lot more flexibility and decision-making and that kind of thing. True foreclosures like we saw kind of in 2008 and 2009, those take a while to process. I mean, most people don't realize, but in multifamily, as a lot of commercial real estate, you have a loan that was sold off and it's securitized and there's special servicers and there's a host of people in line to make money overseeing that asset being taken back under control and stabilized. And so sometimes it takes years for those to sell. And sometimes it happens very quickly. It just really depends on who the lender is, what the loan situation looks like. I do feel like on the smaller scale, we're not really seeing a ton of banks foreclose yet. Seems like people are still being given some extension options, but it's going to be coming. There's.
And I can understand when you mention short sales, because I do residential short sales. And sometimes it takes us, 7, 8, 9 months, a year to get something across the finish line, because there's just so much.
The nice thing is that, at least for apartments, all the lenders were fairly disciplined enough that they had low enough loan to values that most of the sales just are really more about a loss of equity. And so those are the great ones to chase. Everyone wants the foreclosure, but when you have to deal with the bank, it's a nightmare. Whereas if you're just talking about, is this guy going to lose 10% of his equity or 90% of his equity, that's the sweet spot, because I don't have to deal with the bank.
Mm-hmm. So I guess my bottom line question would be then is, where would you get leads when they are ready to go? Do they give them back to the brokers? Or how do they market?
You know, at the retail level, it's pretty difficult because as the deal goes back, like for securitized assets, you can actually buy software to track it because it's all bundled up together and sold on the stock market. And so we used it back in the 2008, a service called TREP. There's a whole bunch of them now. It's even in CoStar.
Yeah.
So, you know, we know when a property goes on a watch list, goes back to the lender, who the lender is. It still takes a long time to work out. Probably the better leads would be local banks, appraisers. You know, if you're banking with a bank, making sure that they know, like, hey, I am looking to buy multifamily, buy retail, buy whatever. They know when they have a problem, they can likely solve it. Their loans are not securitized, so kind of no one knows unless the tax bill's not being paid, which is a great indicator of when someone's in trouble. That tax bill.
Yeah.
Yeah. I mean, for larger apartments, the taxes are already escrowed. You know, the lender's paying it anyway. It'll go back to foreclosure before the tax bill doesn't get paid. But for smaller stuff, like with bank loans, where someone's not escrowing the taxes and the lender's not paying them, that's your canary in the coal mine.
So it's just the basics.
Yeah. Appraisers are great, because usually if something's going wrong, they're asking for an appraisal. Yep. Oh, yeah. Property managers, carpet guys, anyone that's likely to not get paid.
Yeah, exactly.
Yeah, as a broker, especially in today's market, do you kind of have a way or a strategy that you use to generate, you know, multiple?
We used to. We just be like, here's the call for offers date, show up, and like corralling cattle, like, you know. Now it's like, please show up. I mean, it's a great example. We did a call for offers, and, you know, ironically, you're constantly having to adapt. Like, I told you about my experience at Marcus & Millichap. They had us read a book, Who Moved My Cheese? Mm-hmm. It's great. It's a simple book. It's truly like almost every day of my business is defined by this. If something's not working, how are we going to work? How are we going to redo? So when Paul and I sat down, what was it, 9 months ago, we talked about some stuff. You gave me a great idea as to how to retool my emails. They've been very productive. On my marketing stuff, I recently was just like, man, you know, whatever used to work is not working. And let's try something different. Where do I think my friction points are? And so it's just a lot of trying stuff and testing it. And then if you find it works, you stick with it until it doesn't. I mean, but I do try to feel out, like, where is the resistance level in terms of, you know, why are people not showing up? And I think it's just today it's general deal fatigue. You know, buyer wants a deal, seller wants more than it's worth. You know, you underwrite 100 deals and you're like, I don't have anything to show for it. Why should I underwrite 101st? So, you know. So there's always kind of been like an acquisition fee in a general syndication, like when people are pulling together investors and buying a deal, and less of a joint venture and more of from raising money at a country club, right? You know, there should be fees. Like, there's a lot of time and effort going into finding that. Yeah, it's generally for the general partner, and often they'll reinvest it or invest it alongside. But it's generally the concept is it's there to recoup costs and keep things running. And I think over the last several years, we just saw those become astronomical with a large number of individuals, mostly who all went to the same courses.
And then you mentioned that potentially multifamilies.
Charleston's holding its own pretty well. I think it's a combination of, I think, people that buy Charleston, much like Asheville, North Carolina. They're small markets. They've performed well. They want more. So you tend to see people bid on stuff that they might not normally in other markets. They're willing to hold it longer to see the return. Or if you're the landowner, you know that I don't have to hold it that much longer to get back to a good time. I think Charleston's values have held up pretty well. You know, I think that's maybe a little bit of a tangent, but like if there was one thing to kind of reflect on, if we're looking at what we would call B and C quality property, stuff built in the 70s, 80s, maybe even 90s, if you really think about the timeline and just fix and flip mentality, no one had any money to fix up their deal starting in about 2006, and they didn't have much money left to do it after that, and then they sold. And everyone that's basically bought a deal since has done lipstick. And I feel like every property I go to is suffering from a capital infusion on the important things, parking lots, HVAC, roofs. Like maybe roofs are kind of easy, but plumbing. And so I do think that we've got a lot of assets that have just been capital starved for, is that roughly 15 years, 15, 17 years? And so that might be the one thing that is going to disrupt values, you know, in a market like Charleston on older assets, is like, how long can you go with the original aluminum windows before you have to step up and replace them with hurricane-rated windows, which require a permit? You know, I mean, there's these things that are just have been overlooked, and how far can you kick that can down the road? But for the most part, I think values are pretty strong. They'll hold up. Single family market here is absurd. It always has been. I mean, even when I moved here in 2007, it was the only thing I didn't factor in and completely misjudged moving from Jacksonville, Florida. A house here was going to cost me 3 times as much money. And that was back then. So I think that for multifamily bodes very well.
These have all been great. Thank you guys for these awesome questions.
Thank you.
Chris, you have given so many really great gold nuggets. How can we as a community support you?
Say good things about me. Spread the word. You know, if you're looking for apartments, feel free to look at our stuff or have your broker look at our stuff. We love working with other brokers. You know, life's too short. Do well, and people will do well to you as well. So, and I love how you guys do your work. I'm blown away by Matt O'Neill's stuff that he does as well. Like, I feel like this whole company is just doing what we have strived to in terms of taking the service to the next level. So as much as I might say, I don't know if I'd work so hard, you know, for the client. We do work hard for the client. You know, we're in an industry that has some great people and has some not so great people, and we just strive to be at the top of that and keep pushing everyone else up.
You do a good job, Chris. So thank you so much for being here.
Yeah, thank you.
We have our next event. Our next main GRID event is November 18th. We'll be here at 5:30 talking about the art of raising private money. We're also going to be showing out at the delinquent tax auction for Berkeley County next Monday. Make sure you know, come on out and learn. If you've never been there before, it's a great learning opportunity. If you've registered, come on out, bid on some property. And yeah, we look forward to seeing you guys next time. So thank you guys for coming out this evening. It's been great.